Hey, it's Chris Young with the Mortgage Company, and welcome to Mortgage Monday. This week, we're going to be covering conventional loans. So, conventional loans are loans that are not insured or guaranteed by the federal government. That's it. They do, however, need to meet federal guidelines so they can be sold on the secondary market to Fannie Mae and Freddie Mac, which are essentially government agencies at this point, but that's another topic for another video. So anyway, conventional loans can be used to purchase primary residences, second or vacation homes, and even investment properties. For today, we're going to cover info related to primary residences and second homes, and I'll talk specifically about investment properties in another video. Let's discuss the credit score requirements for conventional loans. Conventional loans require a minimum credit score of 620. Now, both the interest rate and the mortgage insurance rates are based on credit, so a low score is going to mean higher rates. A credit score of 740 and above is considered prime credit and will generally get you the best rates possible. Depending on the down payment amount, FHA loans, which we discussed previously, are typically a better option for someone with a low credit score, and the tipping point is usually in the 680 range. So let's touch on loan amounts and down payments next. Conventional loans can be classified as either conforming or non-conforming, which are also called jumbo loans. For a single family property, the maximum loan amount to be classified as a conforming loan is $424,100. Anything above that is considered a jumbo loan and is subject to different rules, interest rates, and down payment requirements. Keep in mind, this is based on loan amount. So if a buyer is putting 20% down on a $500,000 house, that's a loan amount of $400,000 and is still conforming. Now, a majority of buyers in this area will fit into that category, so we're going to focus mainly on conforming loans. Regardless of the loan amount, lenders are going to look at the LTV or the loan to value ratio. If a buyer is purchasing a home for $100,000 and they're getting a loan for $90,000, that's a down payment of 10% and an LTV of 90%. The minimum down payment required on conventional loan is 3%, which means the maximum LTV is 97%. So yes, that's actually less than with an FHA mortgage. The main thing to consider though is that conventional loans are credit and risk based, so anything over an 80% LTV is going to require mortgage insurance, and both the mortgage insurance and interest rates are most likely going to be higher with a conventional loan when you're putting such a small amount down. The other thing to consider when comparing the two is seller assist. Conventional loans with less than 10% down payment allow a maximum seller assist of 3%, where FHA allows the seller to pay up to 6% of the purchase price towards a buyer's closing costs. So as you can see, the LTV plays a role in a lot of things, such as the interest rate a buyer will get, the amount of seller assist they can ask for, and if mortgage insurance is required. So speaking of mortgage insurance, let's cover that next. You've probably heard of PMI. Now that stands for Private Mortgage Insurance, and basically it means that the companies who are insuring the loan are private companies, as in they're not owned by the federal government. Because of this, PMI rates will be much more sensitive to a borrower's credit score and other risk factors such as the LTV. It also gives us more flexibility though when we're structuring a loan. Unlike government loans, conventional loans allow a borrower to choose if they want to pay their insurance premium up front or split it up and pay it monthly with their mortgage payment. A single premium, which is paid up front, means the borrower brings the money to the closing and never worries about PMI again. A monthly premium will be paid with the mortgage payment until the LTV reaches 78%, at which point it will automatically drop off. Conventional loans also allow for the lender to pay the PMI. To compensate, they typically charge a slightly higher interest rate. So there's no right or wrong way to structure things, and it really comes down to the specific situation for each person. A good loan officer, like myself, is going to know the ins and outs and is going to care enough to make sure that they're getting their client into the right product. So the last thing I want to cover is a common misconception that I hear from real estate agents. And that being said, there's no judgment here. That's why I'm doing these videos, is to educate people. So anyway, we're going to finish this week off with appraisals. Conventional loans do require appraisals. The lender generally doesn't care what your contract says or if there's an appraisal contingency. They're completely separate issues. As the lender, we need to verify that the purchase price is an accurate representation of value, which helps us make sure that the LTV is also accurate. Now don't panic. Most of the time, conventional appraisals are far less thorough when it comes to calling for repairs. An appraiser will usually overlook small items like peeling paint, plumbing leaks, windows with cracked glass or that don't open, and other things like that. They will, however, point out issues that impact the safety, the value, or the marketability of a property. Some quick examples might be a leaking roof, a furnace that doesn't function, or a septic system that doesn't work. Unfortunately, it does not matter if the contract says as is. A lender is going to want to make sure that these types of issues are repaired prior to closing, or that money has been set aside to repair them after closing if the weather doesn't allow for it to be done sooner. Well, that's it for us this week. As always, feel free to connect with me if you have any questions or you want more details on any topics that we discussed. If you found this video helpful, please like and share. Also, don't forget to leave any questions or feedback in the comments for me. Thanks. Hope you have a great week.